It's a good opening for the market, by the way, after yesterday's move that we saw on the upside. Looks like the pullback continues. 60 points higher for the Nifty now, hanging on to 21,700. The good part is that there is participation from the broader markets as well. The mid-cap index is up 240 points currently. So across the board, actually, the momentum is good. The advance decline ratio is at 2,000 stocks in favor of advances. What's leading the gains this morning? I'm very curious to see what HDFC Bank's reaction is to the numbers. So let's just get that stock first up on board. Okay, in the green, so up 0.5%. The street definitely liked those numbers. Prima facie, as we said, it looked pretty decent. So stock is piling on some weight over there. Apart from that, you have NTPC, LTI, Mindtree, Ultratech Cement, BPCL, ITC that are all in the green. Tech stocks are looking pretty good as well. Tech Mahindra, Wipro are all in the green as well. And then a couple of other names, Tata Steel, Coal India, Dr. Reddy's, Tata Motors, all in the green as we speak. On the downside, though, some of these consumption names are just under a bit of pressure. So, you know, something like a Britannia. Then you have Infosys that's flat. Asian Paints as well is down about 0.2%. But just look at the market go now. 85 points high on the Nifty. We were telling you that there are two positives the market is working with today. One is lower Brent crude prices, and the other is that FIs have come back in a big way. There was large buying by foreign investors yesterday to the tune of 1,500 crores. We also saw record demat accounts in the month of December. So all of this is leading to a positive sentiment in our markets. But broader markets also looking pretty good.
Broader markets looking good. And this power story is playing out really well because on the Nifty, it's NTPC, which is leading the charge 2% higher. Beyond the Nifty, it's NHPC because that is a stock which gets an added fillip. The ROE, permissibility levels, the tariffs have been increased by 50 basis points for all new projects for NHPC. And that's working really well for that counter. SJVN should also benefit, incrementally for all the hydro projects they put up. So even SJVN is up about 1% thereabouts. Beyond the news flow, let's see what else is standing up. A lot of the stocks which have come out with their quarterly updates, they are trending higher. So Kalyan Jewellers, for instance, 4% up despite its breathtaking run, continues to move up. RBL Bank is up and about. Macrotech Developers is reacting well to the update. Sobha is cooling off right now. Bit of a sell-on news playing out after two absolutely intense days of price action on Sobha. By the way, on the power side, look out for Torrent Power. That stock's also flowing through. So in general, CESC has also got the first positive tick on it. In general, it's turning out to be a very positive start for the power setup. L&T Finance, 1% higher on the update. J&K Bank, Equitas Small Finance Bank. So all of the BFSI names that have reported numbers, they have started the day on the positive side. Beyond the newsmakers, let me just look out for any other stocks that could be catching the eye. Well, on the mid-cap screen, the index itself is still up about 0.5%. So it's pretty good going. Names like Cupid, some of these lesser talked about stocks. India Glycols, so they are up and about. But I think we're building on momentum, Rima. So it's about 80 points higher. Not a bad start at all.
Oh, absolutely. And in the face of listless, flat global cues, right? Asia is doing absolutely nothing across the various indices. But the Indian markets are continuing with the bounce back from yesterday. And we've added on 85 points. Mid-caps are up. The mid-cap index up more than about 200 points. Very positive advance decline ratio. Some of the real estate companies are, continuing with that momentum. We spoke about Macrotech and Sobha. Sobha, of course, has cooled off a tad bit. But Indiabulls Real Estate has seen some buying. And you also have Peninsula Land, which is up and about. Apart from that, you've got these jewelry companies looking up. So Kalyan Jewellers, which reported a 33% jump in its consolidated sales in Q3, is up 4%. Moti Sons Jewellers, a small company, recent listing, and that's seeing some buying, and that stock has gained close to about 5%. Dabur, where they reported the Q3 business update, the stock has opened with a mild positive bias. Not too much, but just tracking the commentary from the company where they're saying that there is some improvement in consumer demand, though rural continues to lag the urban demand. So Dabur has opened up with a gain of nearly about 0.5%. But now NHPC is seeing some aggressive buying, 8.5% higher on NHPC, and it's moved up on very, very large volumes. So that's clearly one of the big stocks of the day. Let's now go across to Rahul Arora, the Chief Executive Officer at Nirmal Bang Equities, who's here with us on the show now. Rahul, hi. Thank you very much for joining in. In the face of listless, subdued global cues for the last 2 days, the Indian equity markets continue to march on. Just for the near term, considering there is that weak January seasonality, and typically markets correct in the month of January, what would your near-term outlook be for the markets?
So first of all, morning, and thank you for having me on, and I wish all of you a very happy
Happy
New
New
Year,
Year.
and to your families and team as well. So I think this reminds me a bit of 2013 when the Prime Minister, then the Chief Minister of Gujarat, was announced as the PM candidate in September 2013. The rupee was at 69 and the markets were a bit listless. But in the run-up to the general elections, the markets had a very ferocious rally and the rupee appreciated by almost 10%. I think something similar could happen. The day the state election results were announced, the Nifty was at 20,000 or just maybe a little under. You've already got almost 10%. I think the other important factor, Reema, will be that I think the RBL will probably allow the rupee to depreciate a little bit because India is now included in the JP Morgan index. Now, when those flows come, the rupee will appreciate quite substantially. So I think there will be an interim period where the rupee will depreciate and then appreciate again. I think net-net you'll probably land up being at around 83, 84 for the year, but that probably plays itself out. From a valuation standpoint, I don't think anything can be justified on an FY25 basis. So if you're a retail investor and coming into the market, or even an institutional investor, you need to have at least a 2-year view. Otherwise, if I look at our own broking firm, we track about 185 stocks. I would shudder to think more than 20% would be buys if I value them on FY25. So obviously liquidity has played its part. And I think the overriding theme next year is going to be the rate cuts, right? I think the Fed has already indicated 3 quarters. There are some indications the RBI will follow, if not 3 quarters, by at least 50 basis points. So it's going to be a strong period of the market till May. I would not be surprised if this rally continues till 24, 25,000 by May. The question is what happens in the second half.
Sell the news?
I'd say we're probably going to more of a consolidation phase because if the worst of China gets behind us in the next 6 months, then that emerges as a competitor for capital in the next half. And let's not forget the US and India both go to elections next year. So the US is also going to be fighting for capital. So I think in terms of major flows, it's going to be US, China and India. But I think India could potentially be more front loaded and you could land up seeing a 24, 25,000 Nifty by May, and then you go into a consolidation phase for the second half.
I like that. I'm going to take that. 24, 25,000. That's the optimism we need this Friday morning, right? But jokes apart, Rahul, thanks for joining in. Happy New Year to you. I wanted your thoughts on the here and the now. I mean, we are reacting to HDFC Bank's numbers and they're looking really good. I mean, deposit growth of almost 28%, retail deposits up almost 30%, right? This is one behemoth that has not really performed. I mean, it could do better, especially in people's portfolios. But your thoughts here?
So I think, Sonia, this is a bank that's going to grow its net interest income, its pre-provision profit and PAT by about 30-35% over the next couple of years. Obviously, this is a merged entity now, so we're strictly not talking about standalone. But these are exceptional numbers. Now, as you rightly pointed out, there was a time that HDFC Bank used to trade between 4 to 5 times price to book. On our numbers, that's probably come down closer to 2.6, 2.7. But that's not just true of HDFC Bank. It's true of HDFC Life as well, where on price to embedded value, that stock post-listing had gone to about 5.5 times. Would I be a buyer in this stock? Absolutely. I think there are no concerns. RBI has already adjusted for risk weights on retail loans. So I think incremental retail lending, if you had to doubt anyone in the banking sector, I don't think you had reason to, but if you had to, that'll get a little more prudent right now. The only thing, Sonia, is that because you are going to go into an interest rate cut cycle, my sense is you might see deposit rates at the short end go up a little bit more. So you might find, and some banks are already doing that to garner incremental deposits. So I think if at all you want to say the worst of the banking sector, though that phrase technically does not apply, would potentially be this quarter, because I think NPAs come FY25 will start to look better. NIMs would have bottomed out and credit growth is extremely strong. I think if you look at scheduled commercial banks, they're almost 16-17% growth. If you exclude HDFC Bank and if you include it, it's at 20%. If the Nifty is to go to the levels that I think, it's going to be led by banks, and I think it's going to be led by HDFC Bank. So I would certainly be a buyer. We're expecting very strong growth, and I don't see any reason why retail or an institutional investor should not be adding at this point.
Rahul, hi, morning and season's greetings to you. Let me say that the beauty of age is that you lays optimism with some healthy cynicism as well. I don't remember the last time we started a year with the narrative so positive. But look at the updates, and there's no denying the numbers, right? Look at what real estate companies are saying, banks, look at the way credit offtake is, flying off. Then the rate cut narrative, obviously, which is here. The money flows coming in from foreign investors. We're talking political stability. It's almost too good to be true. It's too perfect. So therefore, let me bring in the healthy cynicism. are there risks that we should keep in mind, or or should we just prepare ourselves for a melt up, like you're saying, in the run up to the elections, and just keep the pessimism and the questioning aside for a bit?
No, I think it's a legitimate point. I don't think everything is, in life, personally or professionally, nothing goes up in a linear fashion. You have moments of consolidation and disappointments at every point in time. The one big call that the whole world got wrong, and I was reading reports by, BCG, McKinsey, and a lot of others, and sell side, buy side, was that the US would go into a recession in the calendar year 2023. That did not happen. Now, does that get postponed to 2024? That's a big question mark. And how long does this China slowdown last, right?
But that's not a worry for the market. Sorry to come in. If they go into a recession, you get 4-5 rate cuts, and the market loves that,
No,
right?
so I think there is a growth trade-off as well. So our own economist, Riza, expects that, this year's GDP growth will be about 6.5% for FY24. That may come down to 6.2% next year. You don't have to incrementally find negatives if they are not. But yes, the biggest negative is, as I said, near-term valuations. You've had 2 wars hit us in the last 3 years, and crude is comfortably placed between that 75 to 85. So I think next year, if you have a current account deficit at about 1.5%, if your CPI average is about 4.8%, WPI at 2.8%, there may be a bit of slippage on the fiscal side because rural has not recovered to that extent. So you may find some amount of grants to, boost the bottom of the pyramid. But then even so, if it's a 20-30 basis point slippage, I don't think people are going to scoff too much at it. So my only concern would be on the export side, where if you have a global slowdown, what's going to happen? But even then, just to play devil's advocate, if India continues to grow at 6% plus in an interest rate cut scenario, even the global growth slowing, and if you have capital, then you still become the receiver of that capital. So, it's a very famous Devanand song, and I think it's probably apt for the Indian markets right now. Even if there is any wall of worry, मैं जिंदगी का ख्वाब निभाता चला गया, हर फिक्र को धुएं में उड़ाता चला गया.
साथ निभाता चला गया.
So
on those lines.
I think you got the drift. So I think it's always prudent to be cautious. I think near-term valuations are concerned, but no headwinds as such. And if China remains soft, commodity prices are again in your favor.
Again,
so I think it's enjoy it. I mean,
so evergreen Devanand, evergreen Indian markets as well, right? But let me ask you about consumption. That's a space you track very closely. Now, 2023 turned out to be pretty good for consumption names, aided by falling inflation. So gross margins went up, EBITDA margins went up across the board for FMCG companies, and that drove the EPS growth estimates. What about 2024 now? What's the outlook?
So, Rima, I'm still not comfortable paying these valuations for consumer staple companies, and I'll tell you why. Because I think if you look at frontline IT, right, the 5 companies, and you look at, say, the mature FMCG businesses, these have now, I think, come to a stage where to get a 10% plus top line growth is going to be very challenging for them. I'm not talking volume growth, I'm talking about revenue growth. This includes, for FMCG, it includes volume, pricing and premiumization, and for IT, it could include rupee depreciation and volume growth. So if I get into so I'm looking at a 5% pivot, right? So I think in bad times that probably drops down to 2-3%, in good times at 8-9%. At 8-9, if I have visibility of 8-9%, then these companies go back to valuations of 50-55 times. But at this current valuation, to be buying stocks like Lever, Dabur, etc. on the staples, I'm not sure. Consumer discretionary, very bullish. Yeah. Even now, for the next 1 year, completely. You've had G20, you've had the World Cup. You have a very big tourism event later this month opening up in Ayodhya. Yeah. So I think that's going to, have an impact on air travel and tourism as well in terms of hotels. So consumer discretionary, I have no problems, but consumer staples, still not yet. And as to Surabhi's point a little earlier that I was saying where fisc may slip, I think the government will have to do something at the bottom of the pyramid to revive that because I keep making this point. The reason Lever stock went from 300 to 3,000 is because margins went from 14% to 25%. Lever's top line 10-year compounded, and that's a reasonable time frame to take across cycles, is only 8.8%, and that includes volume, premiumization, and price. So, and when you talk about all of these, and there's a play on grammage, etc. So, I need these companies to go to about 6, 7, 8% volume growth for me to be comfortable paying these valuations.
Okay, all right, got it. But before we let you go, you spoke about all the big events coming up, and there's the union budget as well. There's a pen and a paper there for you, and there's a huge box next to you.
I
so
see.
That's a ballot box, and that's your attempt to get your message sent to the finance minister directly, so that she can present her budget with all of this feedback in mind. So go ahead.
Yeah, sure. Why
And
not?
also tell us what you're writing.
tell
At least
us what
give
you're
us some
writing.
clues.
So I think this is the budget actually is going to come out in July, right? This is going to be just a vote on account. But I think there is going to be a situation where you're going to have a little more rationalization in the taxation because you're moving to a stable tax regime. Like I said, I think some government spending at the bottom of the pyramid is what probably looks like it's going to happen. But I think anything incremental is going to be only announced in the budget. But I think the fact that the 2 terms of the Prime Minister have been devoted to regulation and putting India on the global map, I think the next 5 years are going to be all about the economy. And I think given what he's spoken about in terms of indigenization, I think it's going to be a great time for industrials, for banks lending to industrials.
Local
and I
manufacturing.
think, And, I remember Rukhsar Shroff of JP Morgan at one of the CFA conferences, somebody asked him years back, which is the next HDFC Bank? And he said HDFC Bank is the next HDFC Bank. And, and I was having this conversation with someone recently and we were discussing with an institutional client who's a large holder of Dixon and he's like, kya karu? The valuations. And the question was, can Dixon become the next Dixon? And just I'm giving it as a metaphor because, when you talk about China plus one in India, there are only 3 or 4 large cap chemical companies in India. Could you have this go to a situation where this becomes much, much bigger? So I think the government will probably want to focus a lot on manufacturing and infrastructure. But for the moment, like I said, it's predominantly a vote on account. So I think there may be something for the bottom of the pyramid, an indication on taxations in terms of consolidation. But I think the big bang announcements will probably come through June. So that's July. That's probably what I'm going to write down. But
absolutely. Well, while Rahul writes down his sort of thoughts and requests and his wish lists to
that's a long one.
to the finance minister.
I think he's going to spend the next 1 hour.
I really hope she hears him on the tax part. I mean, in terms of rationalization, we go in with that hope every year.
Yeah.
The middle class hasn't gotten too much. The corporates got their corporate, tax rate cuts, which really spurred so much of enthusiasm. But for the middle class on taxes, so I hope she's really listening to that particular number. But as you know, that's the ballot box. Rahul, go for it.
I'll just put down my top 3.
Just a caveat here, right? Nirmala Sitharaman herself said that don't have any expectations from this one because it's just a vote on account. The main budget will be, of course, post the election. So before that, there's no major announcement. So we have expectations, but she said don't have them.
On a lighter note, extremely on a lighter note, since it's a Friday, this is probably the closest I've sat to.
Hopefully someday you'll be sitting right next to her.
Thank you, Rahul, very much. A great chat as always. And once again, wish that it's a great year for you and your team, and personally and professionally. All the best to you.
Thank you.
We were just discussing HDFC Bank, so let's straight away get to it because we've had those blockbuster numbers, 62.4% growth in advances. That is the power of the merged behemoth. Abhishek, tell us more.
Well, just to smoothen things up, the merged numbers, that is why you are seeing such a growth of 62% because they have HDFC Limited numbers now in their balance sheet. So to begin with, HDFC Bank's Q3 performance looks strong even on a sequential basis. There is strong loan growth momentum that you are seeing over there. Deposits are up 27.7% YOY and about 1.9% sequentially. Remember that YOY, they have a base effect of being a standalone entity versus the merged entity of HDFC Limited with the bank. Advances growth is at 62.5% YOY and about 4.9% sequentially. There is improvement in credit deposit ratio to 111.5% when compared to 108.4% in the previous quarter. Now, CASA has also inched up a bit, 13.5% growth YOY and about 2.2% sequentially. You are seeing a slight increase in CASA ratio sequentially to 37.74% when compared to 37.63% in the previous quarter. Retail deposits, that's been a strong point for them, grown at 2.9% quarter on quarter. So retail deposit growth is higher than the overall deposit growth because the wholesale deposits are down 3.4%. So the high cost bulk deposits or wholesale deposits are down, which is good in terms of cost of funds being maintained stable or seeing a decline over there. Loan growth breakup, domestic retail is up 111% on a YOY basis and about 3% sequentially. Commercial and rural banking is up 31.5% YOY and 6.5% sequentially. However, the corporate and other wholesale loans, they are up just 11% YOY and just 2% sequentially. Back to you.
All right, Abhishek, thanks a lot for that. Very helpful there. So that's HDFC Bank. But just wanted to point out that the stock of the moment is macro tech developers. Just pull that stock up for you. Another 10% rise is what we've seen in macro tech. Big volumes piling up. This despite the numbers not being that great. So it's really sentiment that's driving the real estate sector at the moment. Of course, numbers are good, but the momentum is so strong in this space that there's gains that are getting piled on. Another sector where the momentum has been strong for the last 2 years is defense. In fact, BEML is one of the big winners of 2023. The stock has more than doubled in the last 1 year. The company has orders worth 329 crore rupees from the Defense Ministry. In fact, the Defense Secretary, while speaking to CNBC-TV18, said that production is likely to cross 1.5 lakh crores in FY24. To discuss the opportunity, we have Shantanu Roy, the Chairman and Managing Director at BEML. Shantanu, thanks for being with us. Happy New Year to you. And, you know, it's been a super run for the sector. We were just having a chat with the management of Paras Defense, and he said that this so-called number of $77 billion annual spend by the Indian government in defense is conservative. He's saying that the spends could be much more in the year to come. I wanted your thoughts on what the opportunity for BEML is over the next 1 to 2 years. Can you share some numbers with us? What's the order book now and what is the order visibility over the next couple of years?
Very good morning and a very happy new year to all of you. Yes, there has been a lot of good opportunities for companies like BEML in the manufacturing sector, especially because we are in the defense and rail and metro, both the verticals. And these are the priority areas of the government. As far as defense is concerned, we are very optimistic about the overall manufacturing scenario of defense production. As far as BEML is concerned, if I talk about the order that we have just got, it belongs to a family of the mining and demining equipment, which is very essential for our defense forces. And it belongs to the family of the combat engineers, which includes the bridging systems. And we are, it's one of our core competencies. This product itself, I mean, this family itself, I'm looking at a number of around 2,500 to 3,000 crore in the next 4 to 5 years. The overall defense order book that I can see, the defense opportunities in which BEML is present for in the next 5 to 7 years should be around 30 to 40,000 crores for BEML alone. And if we talk about the other verticals, the rail and metro, put together in the near future, we should have an order book. We should have an opportunity size of around 45,000 crores in the next couple of years, if all goes well. So that augurs well for the company. And we also have the third vertical, which is the mining. And mining, it's very steady, it's very constant. And mining has always contributed the baseline to the company's top line. And last year, mining contributed 50%. This year also, I'm expecting it will contribute around 40 to 50% of the top line. And mining will always have a steady growth because, again, the government's policy and aspiration to go for indigenization of the high-end mining equipment, where we are very strong. So it augurs well for the organization.
Okay, so just wanted to clarify some numbers. You said 30 to 40,000 crore is the opportunity in defense orders over the next 5 to 7 years, correct?
Yeah.
Okay, and for FY24, your order book guidance, you had cut it to 14,000 crores. You had said that some orders are getting pushed out. Is that a number that you hold on to? And what is the order book guidance for FY25?
FY24, I'll still maintain 14,000 crore. You see, right now, my order book is around 12,500. We are expecting around 3,500 crores in the next 3 months. So we will execute some of those. So we will end the year at around 14,000 crore. And if all goes well, FY25, we should end the year at least 20 to 25,000 crore of order book.
Okay. Mr. Roy, you know, since import substitution, Make in India indigenization has been such a big theme for players like you, can you tell us that earlier in the spaces that you operate in, what was the extent of imports and what does it currently stand at?
The impetus on indigenization has really been very helpful for companies like us, not only in terms of increasing our top line, but also at reducing our costs. Earlier, if we talk about defense, the indigenous content was only around 60 to 65%. But now, with the indigenization impetus, we are able to achieve around 95% indigenization in most of our platforms, most of our products. As far as the rail is concerned, in rail, already we are at levels of around 80-85%. In metro, yes, it's a bit low, around 65%, depending on the type of requirement of each metro corporation. But as far as mining and construction is concerned, we are more than 90% indigenous content in that particular vertical. So definitely we have come a long way from being importing to indigenizing and creating a supply chain in the country to cater to our requirements.
Okay. Mr. Roy, hi, good morning. Season's greetings. So big numbers there on the order book position and, of course, the opportunity, right? But I want to come down to revenue and execution, because when we talk to people in the stock market, I mean, everybody really cheers the huge ordering that's happening, but people are also concerned about how quickly that starts translating into revenue and profits. And if I look at the historical track record, then, you know, it's not been a straight line growth. Because in FY22, your revenue was above 4,100 crores. In FY23, dipped a bit to under that number. First half of this year, you've done, I think, just under 1,500 crores. So what kind of a pickup in execution can we expect in the second half? And when you talk about this opportunity, big ordering opportunity, in terms of, even an annual revenue run rate over the next couple of years, what's a steady state run rate that investors can perhaps expect?
You see, let me talk about the historical data, the historical performance. Historically, our execution has been like 10% in the first quarter, 20% in the second quarter, 30% in the third quarter, and 40 to 50% also in the last quarter. That is how historically we have been doing. As far as the execution, as far as the run rate is concerned, you see straight away the execution cannot happen in most of the orders because there is a gestation period. Except in mining construction, where we have a very short turnaround time of maybe 5 to 6 months in most of the orders. In rail, the gestation period, rail and metro, it is around 24 months to start with, when we build the first proto and then we start the manufacturing. In defense, it is a bit shorter as compared to rail and metro. So immediately execution definitely cannot be done. So we have to focus on the orders that we already have for the execution to take place for the next year. So it will not be... Yeah.
So absolutely. I get that point. I get that point. That is the nature of the business. But then you have an order backlog, right? And that's why it'll help if you can give us some sense on, at an annual level, like FY24, for instance. Do you think you can end with 5%, 10% top line growth? And just a word on margins as well, because that's something that investors have really liked. Your margins have been consistently improving. So perhaps some guidance on whether you can maintain these levels of about 9% or not. And just top line growth this year, FY24, what could it be?
FY24, you see, we have targeted a 20% growth. And
in revenue.
It seems possible as I talk to you. FY25, we will again target 20 to 25% growth, our top line. As far as the margins are concerned, if you look at our half-yearly results, we have already reached an EBITDA margin of around 7%. So I want to end the year with at least 200 basis point growth over last year's EBITDA, which was around 9.3%. So that is the outlook, that is the aspiration that we have. All goes well.
Got it. Okay, so 20 to 25% growth in FY25 is what you're looking at. Before we let you go, we have the big union budget upon us. Of course, this time around, it's only going to be a vote on account. But the government has its sights set on growing the, defense sector quite a bit. So from the budget, either this time or post the elections, what is your key expectation? What are the, gaps that still need to be filled in this sector?
As far as BEML is concerned, the key expectation is that this impetus on defense spending and infra spending should keep going because the top three budget outlays for 23 was defense, rail and metro and infrastructure. And these are the three verticals, these are the three areas which I call the sunrise sectors where we are in. And we'll be hoping that the government keeps up the same momentum in these three sectors so that it augurs fantastically for companies like BEML.
All right, sir, thank you very much for joining in. By the way, IT is making quite the comeback today. Wipro, LTI, Mindtree, Tech Mahindra, Infosys, TCS, all these stocks are seeing gains anywhere between 1.5% to 2.5%. Wipro is the second largest gainer now on the Nifty, and the IT index itself is outperforming by quite a margin, 1.6% gain on the Nifty. IT versus the Nifty up 0.3%. Get into a break. We'll come back. We'll talk realty. We'll be joined by Samantak Das of JLL India, Niranjan Hiranandani of the Hiranandani Group, and Irfan Razak of Prestige to talk about the outlook for the real estate sector next year. Welcome back. This is Corporate Radar. Now, a CNBC-TV18 poll on home buying has revealed that most developers expect sales volumes of new homes to go up even further in the new year. These results come on the back of 2023's astounding highs in the residential sector. The developers we polled say that they are betting on the mid-range segment. Repo cuts and continuing ownership aspirations are the key drivers of this. Jude Sanid joins in with a roundup of this poll.
An overwhelming majority of developers who participated in CNBC-TV18's macro poll on home buying said that they expect the bull run in residential real estate to continue well into the new year. In fact, 40% of the developers we polled said that they expect their own sales volumes to go up by as much as 10 to 15% in the new year, even as 75% of these developers who participated in the poll said that they expect the mid-range sector, that's between 45 lakh to 2 crore rupees per home, to actually outperform the rest in the new year. Remember, these projections come even as luxury real estate has done rather well in 2023, but these developers say that mid-range real estate is the way to go for the new year. Now, 60% of the developers we spoke to said that they expect average weighted prices to go up by as much as 5 to 10% in the new year. And remember, all these projections come even as the one compelling factor that could spur home buying in 2024 being status of home ownership. At least 35% of developers who participated in the poll say so, even as an equally significant 30% of these developers say that equity gains from the equity market bull run in 2023 could also be a factor that could spur home buying. But interestingly, the last poll, or the last question on our poll, raised a few eyebrows. The one big deal breaker for home buying in 2024, 75% of developers say it could well be high lending rates, thereby signaling that those much awaited repo rate cuts by the RBI could play a crucial role in just how well home buying is in the new year.
Okay, Jude, thanks a lot for that. So that's the poll on what to expect this year. But let's get people who have their ear to the ground. Samantak Das, the head of research and REIS at JLL India. Niranjan Hiranandani, the founder and managing director at the Hiranandani Group. And Irfan Razak, the chairman and managing director at Prestige Group. Join in. Gentlemen, morning to all of you. Happy New Year to you and your teams. Mr. Hiranandani, I want to start with you. You know, this sector is booming now, and it's come after a very long lull period, right? The last couple of years have been good, though. Do you expect this performance to continue? And if yes, what could be the big triggers in 2024? What could spur home buying?
Prime Minister Modi.
That's in 2 words, yeah, okay. But no, realistically, I mean, what are we looking at in terms of growth?
Let's be clear. Number one, the GDP growth is 6.2%. Number two, manufacturing is expired. The finance sector, BFSI sector is growing exponentially fast. The IT sector, though there has been an international recession, the extent of IT buying is still continuing in India, and that growth sector is also to be seen. The mid sector is just going exponentially high. I've never seen it so high. Even the luxury segment is growing. So that part of it is there. And the fourth point, which I see, is the infrastructure development that is taking place in the cities. Next week, on the 12th of Jan, the Prime Minister is doing the MTHL corridor in Mumbai. He's doing 2 tunnels in Mumbai, Thane Borivali Tunnel and from Shivri to Marine Drive Tunnel, which is going to be in the 2 tunnels. Of course, there's a foundation stone, while he's going to cross the MTHL bridge, which is 22 kilometers round. All this and more with 300 kilometers of metro going to become operational in the Mumbai region in the next 24 months is going to see a sea change. All this and more is definitely creating boom time for real estate, not only in Mumbai. Mumbai definitely is, but also, and you know, Irfan Razak has now shifted a lot of his work in Mumbai, and he's coming here to take over the markets. And congratulations to him being with us and joining us in our city. But over and above, if you see, the growth of the cities are definitely happening, and India is growing, but real estate will grow faster. And I believe that the multiplier effect of real estate is going to take place in the rest of the economy. If real estate continues to grow the way it is, I'm going to see an 8% growth in GDP by the end of 2024, not the 6 and 7%.
Well, you have always been the eternal optimist, Mr. Hiranandani. Pleasure to have you on the show. And you know, that optimism is finally shaping up. Real estate is, you know, these long cycles play out. You go through a decade of a lull, and you know, this is perhaps the upswing that we are seeing. Let me bring in Mr. Razak into the conversation as well. Mr. Razak, so yeah, you know, actually tell us, because you know, you are making inroads in Mumbai, and that's one trend that we've seen in 2023. Developers moving away from home ground to explore newer geographies. How is that playing out for you? And the bigger question, in this upcycle, where are we? I mean, they say your real estate cycles last for 10 years. So, you know, are we in the beginning, middle? Where do you think we are, and how strong could the cycle continue?
Good morning, and wish all the panelists on the screen and at CNBC and all the viewers a very happy New Year. Yes, the upcycle has started. It's now 3 years. I mean, just post-COVID, we've had a good run. The demand has been consistent, and we are actually producing more and more. And whatever we are producing and launching is getting taken up. And yes, we have moved to different territories, not only Mumbai. We are in most of the south. And now we have moved into Mumbai and doing, not to take over, like Mr. Niranjan said, we are only there to complement and try and see how we can complement and add to the overall housing scene in Mumbai. But Mumbai also has been very good with us, and we've done well. The sales have been good. Whatever sales launches that have been done in Mumbai also, there's been a great response. Now, all this is a culmination of what I believe whichever developer has done well, who has delivered in the past and has the confidence of the buyer. Now, that's where the difference is. So there has been some consolidation, and this will continue. And we only hope and pray that the interest rates don't go up and maybe soften in a bit. That will actually increase the demand. And one point that was brought up by Mr. Hiranandani also is infrastructure. Now, it's infrastructure in all the metro cities is where we need development. If that happens, we can go further and further out and build more affordable homes. And that's the need of the day, because I always have said this, and I believe that the volumes that will come only and only from the mid-income housing, and that's where the demand is. So that's where we should focus. Yes, luxury will do well, but that's a niche market. But the actual requirement is in the mid-housing, and that's where we need to focus on.
Mr. Roy, come in. Samantha, come in on this conversation now. Do we have numbers on the extent of supply which is going to come on board in India in 2024? And if you could break that up in terms of the various metros, what would be the overall available supply which will be there this year? And how would it compare with the past years?
Hi, very good morning to all and a very happy new year. Yes, in terms of residential market, we all know, as Mr. Hiranandani and Mr. Razak, they both said about the bull run cycle. And it was a bonanza year for 2023, where we have seen 26% growth on sales from the last 2022. And in fact, let me give a slight backdrop that it's the all-time high in terms of sales in the top 7-8 cities in India. The last high was in 2010, 2 years after the GFC. It's 24-25% higher than that as well. And we believe that both in terms of launches as well as sales, we will see a good growth in 2024. The prediction of JLL Research is we will see a 10 to 15% growth on sales as well as on launches. See, the numbers of estimates, the estimated numbers vary across various organizations, but very important is the outlook is anywhere between 10 to 15% growth. Of course, we will see a lot of launches, in fact, quality launches, I will say, with prominent developers coming up in the big cities. And if you see the 2023, the tech cities really performed very well. In fact, they have crossed all other cities in terms of growth rate. And very important is in terms of sales also, if you see Bangalore has surpassed even Bombay in terms of quantum of sales, in terms of units. So the point is 2024, there are certain assumptions that we have. As the other panelists have mentioned, we are looking at some sort of a policy rate cut down to the tune of 60 to 80% on a very conservative manner, because 250 bips have gone up in terms of policy rate, and still we are seeing that the home loan is in single digit. So if another 60 to 80 bips reduction in terms of policy rate happens over the year of 2024, our belief is we will see 40 to 50 bips reduction in home loan interest rate, which actually augurs well on sales, because most of the buyers are through home loan, mortgage. So that's one. And second, of course, panelists have discussed about the growth in income, in infrastructure, and we see a lot of strategic land acquisition is happening by developers to the tune of 725 acres in the last 1 year. Which gives a very strong outlook of 81 million square feet of development potential only in residential. So yes, the bonanza year will continue in 2024.
All right. Just before we end this discussion, right, due to paucity of time, I want to quickly take some budget expectations as well. Mr. Hiranandani, your thoughts? Is there any expectation from the budget this time?
There's a vote on account, so I don't expect anything there. But I do think that they will have to look at the affordable housing segment in order to give more incentives for the affordable segment to get a higher income tax rebate. Because what has happened with the interest rates going up and the amount of standard deduction being the same, people are not able to get that benefit. And this is one, interest rate being higher and income tax deductions being leveled at for a long time not being increased. I think the people of India would want that standard interest deduction should be increased in order to give the benefit to that. I think that should be the first demand from the Finance Minister of India, and I'm sure people would like to have houses. Housing for all is the Prime Minister's mantra. And I think we should be able to get that happen. But people can't buy the houses if the interest rates are going to be so high in the affordable segment. And that's a disaster if this sector is not being supported by the government.
Okay. All right. So we take that on board. Mr. Razak, your wish as well. And also just a word on pricing, because when we're talking about affordability, interest rates, that's one part of the equation. The other part is just market dynamics and pricing, right? And where will we be on that equation in this year?
Yeah, firstly on the budget, I like Mr. Hiranandani says, I'll ditto it. We have no expectations, but whatever he has said on the exemptions is I'll ditto that, because it's important that we give this relief to the affordable housing. And if that can be done, it'll be great. It'll spur the affordable housing more. Plus, like you said, the pricing. Now, the pricing has always been a challenge. Now, pricing is a component of land plus construction. We all know that. And looking at the developers' margins, all the listed companies work with single-digit PAT margins. So it's not that the margins are very high and then we are making a lot of money. It's not the fact. So there is, this is not something to do with budget, but GST is where some correction, if it happens, if we get the input credit, or if something can be done on GST for affordable housing, that will be a big relief for the buyers. Because today, whether you like it or not, the developer has to suffer 18% GST on its construction cost, plus the buyer pays another 5%. So straight away, there's a 23% price hike on the product, whichever product you buy, high range or mid-range or affordable. It's the same thing.
Okay, gentlemen, thanks a lot for joining in. There's, of course, this is a sector that's really booming right now. So congratulations to all of you and all the stakeholders of this sector. Hopefully 2024 will continue to be a better year, just as 2023 has been. Thanks a lot for being with us. Well, that's a sort of a discussion on real estate, which is an ongoing theme. Let's take a quick break. On the other side of the break, crude prices have been falling, so that's also positive for our markets. More focus on that in our commodity corner.
Welcome back. Well, it's been a good morning so far. The day's high was 21,750 thereabouts, and we're practically there, 10, 13 points off it. So holding steady. Let's go across to Mitesh to get some trading ideas going. Mitesh, what would you work with today?
Subhi, I'll have a buy on Berger Paints. That's a buy with a stop at about 594 and a target of around 615 on the upside. And Dalmia Bharat Cement is a buy with a stop at 2350 for targets of 2465.
Okay, all right.
Okay,
Thanks very much for that, Mitesh. With that, let's quickly move to commodities as well and figure out what's hot over there. We have Manisha joining in with all the action. Manisha.
Thank you for that, Surbi. Well, not so hot, and I'm talking about the metal as a sector. Well, remember, December was a very impressive rally that we saw into those markets, whether it was metal as an underlying commodity or the metal stocks. But we've started 2024 on a slightly weaker note. One, there is profit taking after that very strong gain that we saw in many of those metal prices. And then it also has to do with the dollar index, which also has seen a rebound above 102 coming back. And this is ahead of the US Fed meeting, and the market's anticipating that you could be looking at first interest rate cut within the first quarter itself. Well, if you look at the markets right now, there is some lack of clarity on timing and scale of the US rate cuts going forward in 2024. And that is perhaps what is also keeping the market slightly jittery here. As of now, we do understand that there's a 70% chance of a US Fed rate cut in March 2023. In the mid-December, it was a possibility of around 90%. So we definitely have come off from those kind of highs. Also, the kind of statements you've heard from European Central Bank and Bank of England, the officials are pushing back against premature rate cut talks right now. And that also has led to some reality check into those markets there. Fitch also has downgraded the credit ratings for 4 China state-backed asset managements, and that has led to some sell-off within China as well. In any case, the China property market, the kind of numbers that we've seen coming from China have been slightly on the weaker side. The PMI number for the month of December also came in lesser than what the street was anticipating, and there has been inconsistent government support as we've seen in sense of stimulus measures, so that continues to weigh in as well. These are the prices that we've seen in 2023 in case of metals. So nickel was an underperformer with 43% of decline. Zinc was the second worst performer with 16% of a cut. We saw decline come in for aluminum as well. So the only sole gainer in the last year was copper, up by 2.5%. But take a look at the first week of 2024, and we haven't managed to actually see a gainer here. So anywhere between 1 to 4% of a decline is what we are working with in sense of metals in the first week of this year.
Okay, thank you very much for that. On that note, we're going to slip into a very short break with the news. The Sensex has reclaimed 72,000. It's a 250-point gain on that index. The Nifty continues to remain steady. The first 1 hour of the market has been extremely steady, 80 points up on the Nifty. On the other side of this break, Lata will get you an exclusive conversation with Manish Shokhani, Director of ENAM Holdings, to discuss his market outlook for 2024. Stay tuned.
Welcome yet again to Outlook 2024. Today it's markets in 2024 with one of Dalal Street's best known, best loved veterans, Manish Chokhani, Director Enam Holdings, but that's a wrong way to introduce a veteran like you, Manish. Okay,
you make me feel so old, but thanks for having me here.
I call myself also a veteran sometimes. Okay, no, actually, when we talk of Outlook 2024, the first thing that comes to the mind is that 2023 was a damn good year, 20% high, and 8th consecutive year of index returns in the positive. Can we be 9th time lucky?
Well, I hope so. If I were a soothsayer, I'd be somewhere else. But see, the macro conditions for India have conspired very, very favorably, as is well known, and the market's reflecting that reality. Surely expectations are running high, and we are priced for pretty much perfect execution and Goldilocks scenario continuing.
Yes.
That risk always remains, but like it's always said that the big balance sheets of India, whether it's corporate sector, banking sector, government, are all in the right direction. So no real reason to say that we should have a big setback.
Okay.
And the big indices are not overvalued.
No.
You may argue something about the mid and the small and especially the SME exchange.
Yes.
But there's nothing yet in the larger caps to suggest that we're anyway approaching a climax in the market.
No, that's fair, but they're not cheap either.
Sure.
I mean, if you look at forward, we may be 19.5, 20.
That's right. It's not a cheap market by any
Yes, so
standards.
that's why it will be more important for you to help our viewers train their eyes.
Right.
So where would you look for value?
See, the first thing is the market corrects due to top-down reasons. It never happens. You buy stocks bottom-up based on valuation comfort, but you lose it from something unexpected happening top-down. And by its nature, an unexpected development is something you're not expecting.
No.
So this market is not priced for unexpected developments, let's put it that way. So what it means is you may want to keep some gunpowder aside to, if and when there is a correction, you may, hopefully have 5-10% money available to dip in at that time.
Yes.
And if it continues roaring, you're happy anyway, your 80-90% which is invested is anyway going to do well. So it's more a question of let's not get into the fear of missing out mode. Be happy with absolute returns, temper your expectations down a bit. Having said that, this is a bull market which will last for long, and there will be rotational cycles sector to sector. And in a bull market, it's very bad to be jumping between sectors, because you miss one, you may not get back on the train. So by and large, it's best to stay invested in companies you know well and not worry about someone else has made so much money in the last 3 months, let me go there and chase that. And then you end up missing everything.
But that I get. FOMO is not a good thing.
So just stay with proper asset allocation and with companies that you like, because this market is clearly pricing in a few years ahead now. It's not about immediate returns.
No, but not all over the place. I mean, there are still banking stocks. For instance, HDFC Bank.
Right.
It's not participating in the rally, nor has Kotak, PSU banks.
Sure.
Do you think there is value in
look, it's a consensus now amongst, I think, everyone you speak to in the market that the large caps is where the value is, as opposed to the mid and the smaller ones. And one shouldn't generalize, but generally saying that it's correct to say that the larger caps is where really the action now should be. Secondly, the banking sector was leading the market. Then it's taken its pause, and then hopefully the next leg starts. In this leg, the PSU banks are kind of rallying a bit more, because until now, all they've done is tracked earnings growth. The multiples have not really expanded. And like I've said on some other shows, that you literally have a menu. You can buy a Canara Bank on a forward multiple of 5. You could buy a PNB or a BOB on a 6, SBI on 7, and stuff like that.
Yes.
Till you get to even the great HDFC Bank will probably be, in a year from now, more than $10 billion of profit. And it's probably a 17 multiple for a franchise of that quality. It could easily be, the Kotak multiple is 24, for example. So there's a big gap right over there. So banking surely should be the leader of this market. But if you think of how this market's been running, very similar to the 2004 bull market, you've gone into all the infrastructure names, because the cyclicals are back from L&T to the defense and the railway names. In fact, Hindustan Aeronautics is now in quartile 2 of India, which one couldn't think of many years ago. PSU banks, of course, are very much there to catch up, but a lot of these public sector stocks are trading on 30-35 times forward 1 year on FY25, which one wouldn't have imagined. So similar to the 2004 bull market, infrastructure, power, real estate, banking, and some commodities have been participating against the erstwhile favorites of FMCG and IT and others. So that's really the typical cycle in a bull market.
Okay, but would you be wary of the power, for instance? You know, I was just looking at the power stocks, risen between 50 and 400% in 2023. So those would be the red flags?
So look, it's a valuation call end of the day that, you know, if you want to buy risk-free, the risk-free rate in a bank gives you, let's say, 8%, which means you're giving an implied 12.5 PE multiple. Our market is on 20 times, which means it's not risk-free. You're priced in, you know, a couple of years ahead of earnings. You know there is a shortage of power because post the 2008 crisis, nobody invested in putting up power. So there is a golden period for the power sector. We as a country are short on energy. So whether it's the oil stocks, whether it's the, you know, coal and thermal stocks, or it's the solar, and I'm very hopeful that we start developing nuclear and other renewables very, very quickly, that there is a, you know, whole gamut of opportunity there, and a lot of the private sector players are of scale and size now. So
but I worry about the price.
Pricing, look, I've said it at the beginning that most of the stocks are now pricing the vision of the investor rather than the entrepreneur. Okay. Like, you know, Mark Faber used to very famously say at the beginning of the cycle, the entrepreneur has the vision and the investor has the money. And by the end of the cycle, the entrepreneur has the money and the investors have the vision. So we are in that phase where when people are buying stocks on 60, 70, 80, 100 multiples, it's clearly going to be maybe a decade for them to get to that 12.5 PE from which they start making the return of equity of the underlying business. Okay. And you've seen this historically, right? Yes. In the 90s, we said you have to buy Hindustan Lever on every Diwali, and then it didn't perform for 10 years. Yes. Then when the tech boom came,
it went to double digit one day.
Infosys peaked, and then it didn't. The stock didn't perform for 10 years, even though the business did well. The great Reliance, DLF, Bharti, they didn't perform for 10 years.
So let me come to this
question. So it's possible that.
When do you exit? What advice do you have?
So the cyclicals typically, when you know there's an end of a cycle coming and this valuation euphoria is going to an extreme, you will tend to see signs of market tops where there will be IPOs or projects which are not for near term but also visionary. Or there are crazy acquisitions being made, or there is a big retail type euphoria or an IPO which comes, which is very large and it fails. Having said the fact that we are not a cheap market, we are not so crazy as yet. There are those, what I call mini bubbles in segments of the market, but it's not yet large enough to take the entire top of the market down.
You gave us an idea of stocks that still have value and where, you know, value has been replaced by vision. But for the market as a whole, what may be the red flags?
See, markets always will fall or correct on external factors. It's never that a company individually can disappoint and take the whole market down, or one sector can take the whole market down. And the risks are actually fairly well known to, you know, most observers of the market, that the mothership of all equity markets globally is USA. The US market has been very, very narrow for a long period of time, where the so-called Magnificent Seven are ruling the roost. And you can see chinks in the armor of at least 5 of those 7.
Which are not AI stocks.
You know, like Apple is already, you know, been declining in quarter on quarter in terms of sales. So it's still growing, but it's not something which should be holding a $3 trillion type market cap, which is close to our entire market cap. You know the issues which are facing Alphabet, which is at the risk of disruption from AI, plus the regulatory pressures on them. You know the issues which are arising in Tesla, and especially now with the way the Chinese have come up with BYD and others. So I won't elaborate all of them, but other than say Nvidia or Microsoft, the others could be at some risk of disappointing the market. And when typically something like that breaks, it causes a steep correction because the risk off trade comes in, and that risk off then naturally comes and affects us far away. You also know the way the G7 have been running such loose, irresponsible fiscal policy. The UK to me seems to be the canary in the coal mine, that they've broken away from EU. They have a terrible trade deficit. They have a terrible fiscal deficit. If anyone were to rate them the way they rate India, it would not be investment grade.
It won't be investment grade.
But that currency has not moved. Like the Japanese yen has gone down 50% in a year, but the pound sterling hasn't gone. And the US, every time they raise the debt ceiling, they're at $35 trillion of debt. And that can't hold the reserve currency status forever, pulling wool over everybody's eyes and just printing their way out of trouble every time. So already you see the signs from the Chinese and the Russians and the Saudis saying we don't wish to participate over here. it might take a bit longer to break, but you need one bond market failure or one blow up of a bank, which, with 4-5% interest rate hikes, someone has taken big losses somewhere in the system. And it can't be one Silicon Valley bank which is blown up. It can't be that the Fed is holding all the losses over there and there are no consequences. So something like that breaks. How it breaks, I don't know. We all know the issue of what happens in East Asia if China decides to flex its muscles, now that the US is out of its arsenal supporting Ukraine as well as Israel. These are unknowns. But if they come, they can put a light under our sanguine Goldilocks scenario to our markets. Even domestically, while everything looks pure blue skies, we know there is the, post this election, and we are all assuming there'll be continuity of policy and direction and government and so on. But, when these new seats have to be recast between North and South, there's the Uniform Civil Code, there is the CAA, there was agricultural
so there can
reform.
Be social disruptions.
So we saw things which happened which put sentiment back. It doesn't change the underlying fundamentals of the country, but currently, we are pricing ourselves for clear blue skies. Everything will work as we want every month for the next few years, not just a few months. So that warrants some caution. But again, like I say, a bull market exceeds your expectations on the upside, the way a bear market exceeds on the downside. So I still personally believe that in this decade, India is a big economy in a sweet spot of the type which may cause a gigantic bubble to emerge here, like we saw in Japan in the late 80s. We saw in China, and therefore it's not only about economic performance, it's about how the market prices that economic performance, which determines your long-term returns. So I'm hopeful we don't cause a bubble, and we do get these minor shocks from time to time, so we kind of go up gradually climbing a step rather than taking an elevator up and then the elevator down.
Absolutely. Actually, you were explaining to me the China-India performance from 2008 to now.
I mean, China has been the best economy of this world for the last 20 years. And if you are a stock market investor, your returns are zero. Because
from 2008 to today.
Yeah, even 2000 to 2023, because the last 2-3 years have been so terrible, they wiped everything out. And they had two big spikes in the interim. I don't know if you can pull up charts and put them
we are
up.
showing the charts.
But if post the 2008 crisis, they spiked. In the mid 2010s also they spiked. And that's the creation of the Alibabas and the Tencents and all of the world, while the rest of the market suffered. And China is cheap. China is less than,
cheap,
it's less than half of GDP is the market cap of China. We are probably at 1.25.
So you see that as a competition taking away money?
So it's a very consensus trade in the world to avoid China at all costs and be overweight India. There are no investment committees in the world who would sign off on putting fresh money to China. And the market doesn't just turn when it's cheap. The way I'm saying, our market won't just turn because it's expensive. You need some catalyst. And in China, until the locals start getting confidence to come back in their market, because they are so nervous with the money they've lost in property as well as in stocks, and with the regulatory changes which come unexpected. So the mood is very, very, very negative. So value buyers are fishing there, and stocks are really cheap. I mean, I can't begin to tell you how cheap stocks are in China.
Okay, so that's something.
But if you look out 3 years from now, will the Chinese market be double? It's probably a good bet to take. I can't say that for India, much as I'm patriotic and I'm fully invested here.
Yes.
But we've paid a lot of price.
But then there is a political risk also in China,
absolutely.
which perhaps foreign investors are worried about. No, let me come back to India and to stocks.
Sure.
The Zomatos, the Nykas. I mean, what's your view? Are the digital e-commerce, the tomorrow stocks? Were the
look, they're great businesses. They're run by very, very competent people, and they've delivered and executed very well. They've virtually become monopolies, oligopolies, or call them what you will. The pricing, as a value guy, I find it hard to digest that I'm paying pretty much for 10 years of perfect execution, no competition, rising margin profile. It's a hard bet to take. But can they deliver it? Can they execute it? Yeah, I mean, sure.
But I'm going to make money after 10 years.
Well, I don't have so much money that I have to worry about what I've missed. And one thing I've learned in the market, you don't ever have FOMO. If someone's making it somewhere and they understand they're justified the returns they make, if I understand something else and I can play over there and make my adequate returns, we should be happy with that. And that's all I would say for most investors. We can't have a circle of competence which covers every stock in India. Go where you understand. Valuations, to me, all I've learned in life is my ability to predict is very, very bad.
Okay.
So my only defense is buying cheap. No, no one knows it, right?
Yes.
You could be president of United States and you don't know what's going to happen. So no one can predict the future. Your only defense, as all the gurus, Buffett onwards, have said, you buy at a price which is so good that you then don't worry about all these external risks and, you know, a funny person coming and running the company and so on. The price what you pay is really what determines your returns.
You discuss the PSU banks or even banks, even private banks, in that vein, that they are not overpriced.
They're not at all. I think they're still very, very solid returns.
Anything else?
On scale.
Anything else?
So it's a rotational bull market. So from time to time, you know, things fall off the radar.
Like pharma.
Like pharma, for example, last month was a dog sector and it's been performing very well. So like it will happen in this bull market that certain times it's, you know, the defense and railway stocks are leading. EMS, for example, was something we spoke about.
What about EMS actually, since the government has put its might behind
it's a complete white space sector today, and I've often given the analogy of it being like the Maruti moment when Suzuki came into India and it changed the whole automobile sector. Same thing when GE came to India, they changed the whole IT services sector. The whole ecosystem is going to get cast with the coming of Apple in India. Apple's on a $10 billion run rate from India. Their ambition is to be $100 billion. The entire ecosystem is being made. We are still at the very bottom end of the value addition chain, and I know very famous people talk very dismissively about that we are screwdriver guys. You start like that. You don't reach the top of the semiconductor chain straight away. Design and the machinery making is very, very far away, and these are consolidated global businesses. But assembly, packing, electronic, if you don't make it, you'll have a big import bill. So it has to be done in any case. The industry is still very, very small. Valuations are fantastic. There are 60 multiples, 50 multiples on FY25. So you must be a real believer because these are low margin businesses as well.
Yeah.
So their ability to deploy capital, produce those returns in a modular fashion rather than, you know, whole hog, it's not easy.
Thank you very much, Manish. I'm very sure this is going to be one of our best shows. Thank you so much.
Thank you so much.